In this final chapter, we pull together a number of different themes from the course. In particular, looking at the question, how can management get assurance that risks are managed and that controls are in place and are effective? Now, dealing with that question pulls in knowledge that we've touched on from a number of different areas, in particular audit, corporate governance, controls, and IT. So we're going to start off by looking in a bit of detail at how auditors go about doing their planning and risk analysis and therefore deciding where to audit and what to prioritize. We're going to move on to look at the different types of tests that auditors carry out. Now, it's important that you understand the different types of tests and that you're able to think about what sort of tests would be appropriate for dealing with certain risks. The reason for that is that there's a fairly common style of exam question that goes something like this. How could auditors check for or test X? If you think about the structure of how exam questions can work, it's reasonably obvious to ask what are the risks involved for a certain organizational situation, to then go on to ask, well, what controls would you put in place, and then finally, for a few marks, you can ask how auditors might test those controls. So you need to be able to come up with reasonably specific audit tests that would be appropriate. We're also going to touch on auditing in information systems environment. So if you have a process or an organization that's very heavy on technology, it is different to audit compared to situations that are not so heavy on technology. For one thing, there is no paper trail, and another factor is that specialist expertise will be required. We'll then look at where internal auditors, and indeed external auditors, report to, as the auditors report into the audit committee. Now, we've mentioned this a few times. It's a very pivotal concept in corporate governance. It's a very, very important concept in your exam. So we'll look in a bit more detail at what the audit committee does and what their responsibilities are. And leading on from the audit committee, we'll move up again to the main board of directors and think about the review that the board of directors is required to carry out each year to ensure that controls are effective, bringing us back full circle to the ideas around corporate governance and also control. Now, we'll start off by thinking about how auditors go about planning their work. And we said previously that an audit was a systematic evaluation. In other words, it is something that is planned and then carried out in accordance with that plan. So what they're trying to do when they do that planning, make sure that they are prioritizing the work correctly, tackling the high priority work first, that they're clear about what the audit is trying to achieve, and making sure they're being efficient in terms of how they use resources. Now, one piece of homework you could carry out if you work in an organization that has an internal audit function is to talk to someone from your internal audit function and perhaps ask them how they decide which areas they're going to audit. I'll give you a clue. If they reply that they start with the departments beginning with A and work down to the ones beginning with Z, that's probably not a great way of prioritizing. So what do you think they should say? What do you think the internal auditors should think about when they are deciding what their priority should be? What are the various factors they should take into account? Have a think about this, jot down your ideas, and then press play when you're ready to debrief. Okay, so what do internal auditors need to think about when they are deciding which parts of the organisation they could focus on? Well, in a sense, you could summarise your answer to this in one word: risk. What the internal auditors are going to want to do is focus on those areas that they think are more risky, and they're going to leave the areas they think are less risky. But what are the factors that will influence that judgment? What are the things to think about when determining the relative risk areas of different parts of the organisation? Well, one of them might be perhaps the volume of transactions. All else being equal, an area with a high volume of transactions might perhaps be more risky than an area with low volume of transactions. They may also want to think about the size of the transactions. Again, areas with large transactions being processed may well be more risky and will certainly have more impact on the organisation than areas processing low values of transactions. They may want to look at any history of error or fraud. If there is error or fraud in a certain part of the organisation, then probably they should concentrate on that area a bit more until they get assurance that the issue has been dealt with. Any new systems may well be more risky. Systems that have been in operation for a number of years are probably well understood and proven, whereas new systems are less so, so perhaps they should be audited. They may want to look at the quality and perhaps the experience of staff or management. Now, this will be a sensitive area and will need some careful handling politically, but if you have new staff in place or new management in place, then perhaps there are more risks there than people who've been in position for a number of years and really understand those processes well. They may also want to look at what they think are the adequacy of the current controls. If internal audit's perception is that controls are generally quite good, based on previous work or based on the general impression, then perhaps they may consider it to be lower risk than an area where their impression is the controls aren't so good. So we can say that for internal auditors, and indeed external auditors, risk is a key factor in deciding where to focus their efforts and what sort of work to carry out. But we can actually break down that concept a bit more as well, because auditors think about risk in a number of different categories. Firstly, you have inherent risk, which is the risk involved in any activity, regardless of what controls you may have in place. So, for example, if we're thinking about financial systems, certain activities are just high risk, and usually in financial systems, anything that is subjective involves high risk. So where you have accounting entries being based on judgment, such as bad debt provisions, for example, then that is a relatively high risk area compared to, for example, cash processing, where there is no subjectivity and the inherent risk is much lower. The second type of risk is control risk. And as it says here, this is the risk that your controls are inadequate or your controls fail. So this is the risk that, for whatever reason, your controls are poor. The third type of risk is residual risk, and that is the risk you still have after implementing controls. So there is always going to be an element of risk in any activity, really, and the risk that remains is referred to as residual risk. And then the final type of risk is detection risk or audit risk. And this is the risk that the audit process doesn't detect errors. Now it's worth noting, this is the only one the auditors can influence. So a well-planned audit will aim to minimize detection risk. However, the area being audited will have inherent risk, control risk, and residual risk, and there's nothing the auditors can do about that. Now, once the risk analysis has been carried out, a detailed plan will be necessary for the audit. And in thinking about the planning for an audit, all that's really necessary to say is that an audit is a project. It has a beginning, it has an end, it has specific goals, specific resources, and so forth. So it may be helpful when thinking about questions on audits, particularly specific audits being carried out, to think about your assumed knowledge on project management from E2. Like any project plan, the plan for an audit will include such things as the scope and what you're intended to carry out, what your dates, deadlines and milestones are, what resources and budgets are being committed to the project, and so forth. In this next section, we look at the different types of audit tests that may be carried out. Remember what auditors are trying to do here. They're trying to collect evidence to achieve their objectives. Now, in the case of external auditors, they're looking for evidence that will help them decide whether the financial statements are true and fair. Internal auditors may have a range of objectives, but a typical one might be to decide whether the controls in place in a certain area of the business are adequate. What auditors will start by doing is something called walkthrough testing, and this is when they take one, maybe a few transactions and follow them through the process. For example, they may take a customer order and then follow that through to some sort of stock requisition, and then track that through the dispatch note when it was sent to the customer, and then track the payment received from the customer being banked and being accounted for. By following a transaction through all of those processes, the auditors will give themselves a good understanding of how the system works. What they'll also look at is what controls there are in place at each stage to ensure the system's operating correctly. For example, is the dispatch note agreed back to the customer order? That would be the sort of control we might expect to see in place. Having confirmed that they understand how the system works, auditors will then typically test whether the controls are working as they should. So having identified that, for example, a control is in place that dispatch notes are agreed back to customer orders, what will typically happen is they will then take a sample of dispatch notes. Maybe 20, maybe 30, there's various software in place that will help you decide how many transactions you need to test given certain parameters. So they'll take, let's say, 30 dispatch notes, and they will check whether each of those have been agreed to the customer order. And is there evidence that they've been agreed to the customer order? Has someone signed off to say that this has been done? If the 30 transactions have all been agreed to the customer order, the auditors can conclude that that control is effective. It is working the way it should be working. If any of them have not, then that indicates the control may well not be effective. And depending on exactly how many, there may be follow-up action that's required, or it may be that auditors simply cannot rely on that particular control. Now, substantive testing is something that is more frequently done by external auditors, but is sometimes done by internal auditors too. And substantive testing takes a certain transaction and checks whether that transaction is valid. So if you have a certain balance in the balance sheet, let's say debtors, then one audit test you could carry out is to check with customers whether they agree the debtor balance. And if your customers all agree the debtor balance, then you can be confident that that debtor number is correct. So it's actually checking substantive, the substance of the transaction, to see whether it's correct. Now what will happen, again this is more true of external auditors than internal auditors, but if the controls are assessed as weak, if you've looked at the controls and you don't think they're very good, or it's a high risk area, then often you will increase the amount of substantive testing you do. Now there are different types of substantive tests, and it is important to understand these because, as mentioned previously, you may need in the exam to decide what tests would be appropriate to deal with a certain risk or a certain area. The substantive tests can be remembered by the mnemonic AEIOU. One of them is analytical review, which we'll deal with very shortly. A second type of substantive test is inquiry, so you ask questions. And quite often you may talk to staff or you may talk to customers, suppliers, outside parties and check whether the information you have tallies with the information they have. Sometimes there is physical inspection, and particularly this is true of non-current assets. They may be audited by going and looking at a factory or a piece of machinery to check that it's there. Or it may be observation of certain procedures, an example here being inventory counts. You may go and observe the inventory count happening to make sure that the inventory number is okay. or you may do some sort of computation or recalculation. Now, quite often, as mentioned previously, you use sampling if you don't feel it's possible to cover all the transactions in a population. And as mentioned before, there are various statistical techniques that will help auditors decide how many should be in their sample. Now, one type of substantive test we'll focus on briefly is known as analytical review. An analytical review is about data analysis. And this can be quite a simple but quite a powerful audit technique. What it means is comparing the data with some sort of standard or expectation. And the expectation typically might be last year's data, if you think that financial ratios should be stable year on year, or that data should be comparable with competitors, so you're looking at competitor data. What this means is that if the data does not fit your expectation, it may indicate that there's a problem. I can illustrate this with a simple example. Let's say that you are looking at a company that has debtor days this year of 25, last year was 27. Now, in general, it is possible to form an expectation about debtor days, the number of days it's taking to collect payment from your customers. If you don't have any particular changes in your customer base or your product base or your terms of trade or the economy as a whole during the year, you probably wouldn't expect to see too many changes in debtor days. You would expect that the numbers would be pretty much stable year on year. So the data we have here, with a very small movement in debtor days, is in line with our expectation. That gives us a certain amount of confidence that this data is correct. Now, because debtor days is calculated as being debtors over sales, times 365, what that then means is that if we are fairly comfortable with this debtor days number, and we're reasonably comfortable, let's say, with our sales number, because we've done some testing on sales, then that means that the debtors number that we're looking at is probably more or less accurate as well. So that's a very quick, simple test that can actually give us quite a high level of assurance about the data we're looking at. Remember, the key point here is your expectation. What do you expect to see? And the more detailed and more supportable your expectation is, the more powerful a test analytical review is. Now, there are specific issues connected with auditing in a technology environment, and there's actually two types of audit that you might be asked to deal with in the exam on this one. Firstly, you may be asked to talk about auditing of systems development. We looked in a previous chapter at the systems development life cycle and what some of the risks involved are in system development, while internal audit may have a role to play in actually auditing it. And then secondly, once the system is actually up and running and in place, internal audit might audit the computer system itself. So in terms of system development, we've looked at the risks. We think internal audit may have a role to play. How do you think they could do that? What procedures do you think internal audit could carry out to reduce the risk? Remember your systems development life cycle and have a think about what audit tests may help. Remember, whenever you're asked to specify audit tests, be as specific as possible. So have a think about that one, and then press play when you're ready to debrief. So what could internal audit do? Now remember, internal audit aren't actually doing any of the steps in the systems development life cycle, but they may have a role in checking that those steps have been done properly. So an example of what internal audit could do might be that they review the project team. So they look at who is on the project team, maybe look at their CVs, and check that the team has the right experience and the right expertise to be on the project team. So they can check the input into the process, if you like. They might want to review the business case that's been put together by the project team, and They could check the assumptions, check that the assumptions look valid and reasonable, and they might want to check the calculations as well, to check that they've been done correctly and in line with best practice. They might review the suppliers selected. They might want to check that the suppliers selected are financially stable. Remember, one of the risks in any type of use of suppliers like this is that the supplier fails financially, so internal audit might want to check their accounts. They might want to check that the contracts have been reviewed, that legal have been involved, and the contracts give adequate protection to the organisation. They might want to review the progress reports issued by the team. Check that any issues that are arising have been dealt with. An internal audit might well conduct some sort of post-completion audit. And see whether, with hindsight, the goals have been achieved, whether the documentation is complete, and whether there are any lessons to be learned for future projects. Now, the other aspect of auditing in an IT environment that we need to deal with is auditing the computer system itself. And you've got a number of principles set out here. Obviously, before you do any audit process, you need to understand how the system works, and that allows you to identify how it can be tested. That is going to vary from system to system, but is likely to include looking at the general controls. So what are the controls in terms of background over access and backups and so forth, and you're also going to want to look specifically at the application controls. So the controls over the input, process and output of the application. Think about how you can ensure that they are operating, that the input, process and output are working as they should be. Now, auditors can also use something called CATs, Computer Assisted Audit Techniques, to help them. There are technology tools that can help them. And you may do this to actually review the system controls, to check that the system controls are working as they should be. For example, you might use a piece of software that generates test data, generates dummy data, which is then fed into the system, and you're checking that it's processed as it should be. You'll have an expectation about how it should come out. You can check that it comes out the way it should be. You can also use CATs to look at actual data, and in particular, there are sort of data analysis tools, of which Microsoft Excel is one, but there are also some very powerful data analysis tools that will work out regression, correlation and statistical trends. And that means that you don't need to spend so much time checking things manually. You can analyze the data to see if there are any errors or anomaly. So how do you think this could be an improvement? How do you think this could help you do an audit using interrogation packages as opposed to doing your audit manually? See if you can come up with some ideas on that, and then press play when you're ready to debrief. So how can these automated tools help in comparison to manual audit tools? Well, for one thing, they allow for much greater speed of analysis. Computers are much quicker at analyzing data than people are. So you can perform a number of analytical tests and reviews of data in a fraction of the time it would take you to do it by hand. Secondly, these tools are much more accurate than any sort of manual checking or testing. So if you're doing, for example, recalculations as part of your audit tests, which is one of the ones we mentioned, they'll be done a lot more accurately by automated tools than manually. They allow you to review a very high volume of transactions. In fact, we mentioned that when doing substantive testing, it's very common for auditors to select a sample of transactions to test, because that's all they've got the capacity to do. Well, with automated tools, you might not have to do that. You might be able to review the whole population of transactions. You might be able to review every sale that has been made during the year and run some data analysis over it and see whether it conforms to certain expectations. You might be able to pinpoint any anomalies and therefore any transactions that need further review. And because of all this, it frees up auditors' time to deal with more analytical review type issues, to take a step back and think, okay, where are the risks? Is there anything here that feels wrong? Is there anything here that perhaps we ought to be following up on?